It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studio is my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Target date funds are a common investment option in most 401ks, but how do you know whether they're appropriate for you? And if you decide they're not for you, what strategies do you use instead? We're answering questions like these that came from fans of the show on this episode of Wise Money.
Yeah, pretty much. I remember when they became a thing. That dates you. That I remember a time when you could look at a 401k and the investment options, and there wasn't a dozen or so target date funds. And now I would argue, and Kevin, you might be able to fact check me on this. I feel like every plan has target date funds.
Yeah.
It's a staple, it feels like. So the question is, when are they the right fit? When are they not? And if they're not, what do you do instead? We're answering just questions from fans of the show, starting with that one. If you have a question for the program, we'd love to hear from you. You can call or text us, 574-222-2000. That's 574-222-2000 online. WiseMoneyShow.com is where you can find us. Leave questions there. That's where actually the majority of the questions we're going to hit today have come from. But then all over social media, wherever you're at, we are there as well. Just search The Wise Money Show on YouTube. We get a lot of questions there. And then other venues and social media. Just look us up. Okay, so Kevin, you've said before that your investment allocation, or how you invest your money, if we were to arm wrestle over, well, what's the biggest, most important, most impactful financial decision that you're going to make in your lifetime, it's your asset allocation. So how you invest your dollars, your 401k, your wealth, is critically important. Whether you believe it's the number one, and top answer, or two or three, it's critically important. And so therefore, whether you should use target date funds in your 401k, or if they're not the right fit, knowing what to do instead, that's absolutely a fundamental question that each of us that are contributing to the 401k have to answer. So we're starting with that backdrop. Here's the question from Erica. You've shared that target date funds are not the best investment strategy. I wouldn't say that, but you could take that. But who says we have to choose our actual retirement date? Interesting question. What if I chose a target date fund that's 10 years or so beyond my retirement age? Does that provide the risk that I might need over the long term while still giving me diversification that I'm looking for? If not, help those of us who don't really understand investments to know what the other options are. That's a fabulous question, and again, multifaceted. So let's start with what's this target date fund? How do they work?
Well, a target date fund is a pre-mixed formula with different, and it's one fund, and it's basically a fund of funds. So within that one fund, I've got an asset allocation, and it's going to be based on the year that in theory, it matures. And it's kind of confusing a little bit because some target date funds are to that specific date. So think the plane lands on that date. So if it's way out in the future, then today it's going to be more aggressive and have more exposure to equities. But when I get closer to retirement or on that date, I should see something very conservative. And it can be confusing because when we've seen some pretty amazing down markets, we've seen target date funds, people that have retirement, if you had there are people today in 2026 that have 2025 target date funds, and they could actually see losses in those accounts if the market went dramatically in the wrong direction. So it's a little confusing because you think, well, once I hit my target retirement date, I should be in safe mode. But the truth is, most people, from the time they retire until the time they leave this earth, there's a pretty decent amount of time. And so for that time period, you need to have some exposure to equities.
So what are pros and cons? Because Erica starts with, and I'm not taking exception to it because I mean, I'm not a fan of target date funds, but there are pros and cons. So she starts by saying, you've said they're not the best investment strategy? Well, it's going to depend. It's a great place to start. It really is. And I would say one of the main advantages is, Kevin, just like you said, it's already prefabricated. You do need diversification. Don't put all your eggs in one basket. And for many people, I don't know how to start or what that mix should be. And so a target date fund helps get you there. I mean, doctor said I need more protein. And so I do a protein shake where I'm mixing my own stuff. But then I did get in this habit of I don't know if you've ever had that oats overnight. Oh, delicious.
Are those similar to the overnight oats?
Yeah, maybe. Okay. Is that what they call it? I don't know. Josh renames stuff all the time. Now I'm renaming things.
Sounds like
okay.
it.
My bad. No offense to that great brand. However, you just rip the pouch open. It's already got the right concoction of sugar and then more sugar and then sugar and then some protein and then a little bit of oats. I'm just kidding. But here's the thing. So it's I can just tear it open and I throw it in the milk and I'm good. I don't need to overthink it. However, I actually don't know the ingredients. And so that's both the pro of target date funds. I get it. I just rip the pouch open and target date fund has what I need. However, you don't fully know the ingredients. So if you are trying to be lighter on the sugar or more on the protein, you actually don't control it, right? That in that pouch, there's 20 grams of protein. I have no idea how many added sugars. But if you want to have more control over those ingredients, then that's where target date funds fall down.
So when you think of a target date fund, think of an automatic transmission. It's just going to shift as you push on the gas versus a manual transmission. And you say, well, why would I have a manual transmission? And if you're below 40 and below, you probably don't even know what a manual transmission is because they stopped making them. I grew up with 3 on a tree. And so you had to know how to shift. Well, with a target date fund, you don't have to know how to shift. When's it a good idea, or when should I consider it? If I'm just getting started, if I'm 25 and just getting into the 401k and I don't have any money in there, the journey of 1,000 miles begins with the first step. My first step might be into a 2065 target date fund.
Yeah.
And so I say, hey, I'm going to start accumulating some money there. There's another pro, depending on the investment choices you have in your retirement plan, you might have a decent target date fund, and some of the other choices, if you were going to build your own, might kind of be stinkers.
Okay, I'm smiling right now because you guys don't throw anything at me. But yeah, I've got a friend who's got more than $1 million in her 401k.
It's all in target date fund?
And I'm telling her to keep it all in target date fund because when I look at the other ingredients,
they're stinkers.
Yeah, too much sugar and too much fat, and you can't build a diversified mix. And I've looked under the hood of that target date fund. I'm like, okay, this one is actually pretty decent.
That's an important distinction to make because a lot of times people just assume that the target date fund is made up of all the same investments that you would be choosing yourself. And that's not necessarily the case. It's prepackaged, as we've been saying, but it's prepackaged with the mutual funds that company selected. You don't always know what's under the hood other than maybe a list of some of the key names or whatever. And so, to me, this idea of, you use the analogy, Kevin, of an automatic transmission versus stick shift, essentially. And the only difference, though, is these target date funds, they only shift down in the level of risk. They don't really shift back up over time when it's strategic or whatever. It is on a pre-scheduled.
Yeah, that's a good point.
As time goes on, you get closer to retirement, and therefore, whatever the conventional wisdom was that was baked into that target date fund, it is on a pre-planned schedule to reduce the risk down to a certain level by the time you get to retirement. And what Erica's cleverly saying is, well, if it gets too low in risk, lower than what I would really want to be at retirement, what if I just pick a target date fund that pretends that my retirement is out 10 years later, maybe? Yeah. So in other words, when you get to age 65, you might still want to be investing more like a 55-year-old. That's effectively what she would be pulling off with her strategy.
I've done it.
Yeah.
I've helped clients do it. Sometimes that target date that you would use, if it makes sense that using a target date fund is appropriate, then Then the next question is, well, what target year? It doesn't always have to be the year that you think you're going to retire. There could be strategic reasons based on the risk and the asset allocation where you might want to pick a different year. So I agree, Erica. Not only is this a fantastic question, but even that strategy, that can make sense. Now, I want to get a little bit more focused, though, and get to her question. Well, if you're not great at investment selection, do you still just go with the target date fund, or what should you do instead? So we've got that and questions from more fans of the show. All that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning. Also on the on podcast as well, but also on a couple local radio stations at the same time, which is why the content's broken up the way that it is. We've got segments and commercial breaks. That's what we're on right now. And if you say, this doesn't really fit, I want something shorter, or it doesn't feel like it's tailor-made for YouTube, well, we've got a lot of other content that is. Next Wise Step videos and shorts that are built specifically, more concentrated, 8, 10, 12 minutes long, or shorts that are obviously much shorter than that, built just for you, for our YouTube audience. So make sure you hit that subscribe button, turn on notifications so you're aware every time we drop new content, and leave questions and comments below as well. We appreciate it. I really, on this topic of target date funds, where have you used them? Where have you found success? Where have you said, I feel like something's lacking? Would love to hear from you.
I love the comment section, especially when listeners say, "Hey, this is really good. This has worked for me," or this has been
share your experience.
This has been not a great idea for me.
Yeah.
So
right. Okay, we'll pick it back up. We are going to have to pivot over to start the second question as well. So let's not get too
drive the bus here.
But let's answer the question. What would you do? Because it's a hard one. Mm-hmm. All right. Target date funds within your 401k, your 403b can be a great idea when you're just getting started. They can be a great idea if you don't have a lot of other diversified options. But if you do, and you can hand select the ingredients for your diversified portfolio, that's where target date fund may not be ideal, but how do you know the right mix to select? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Fantastic question from Erica here. She said, you shared that target date funds aren't necessarily the best investment strategy, but who's to say you have to choose the actual retirement date? What if you chose one that was a different age, or 10 years later? But here's the question we're trying to get to right now. If a target date fund isn't the right fit for every situation or for my situation, what should those folks that are not those of us that don't understand investments or aren't savvy investors, what should we do instead? So guys, what do you think? I would say that never target date funds. No, that's definitely not the message. Mm-hmm. They do fit, and they can fit, and I tried to mention it, but they can fit when you're just starting. They can fit when you look at the other diversified ingredients and you say, I can't build a good portfolio around this.
That's one of 5 questions you need to answer when you're dealing with your 401k or employer-sponsored retirement plan. So a lot of times people think, well, my investments, that's the big deal. It is a big deal, and over your lifetime, it's going to be a huge deal. We meet with folks in their 50s, and the difference between the folks with $500 in their retirement plan and $1.5 million is, in a lot of situations, it's just the asset allocation. It's just I let it run a little hotter even during the bad times, and I left it alone, and here it is. It's grown to a pretty amazing amount. So for sure, the investment piece is an important component of the decision-making process in your financial life. It's not the only one. I would almost argue with myself and say whether you do pre-tax or Roth is almost as big of a decision as how should I invest it.
You're kind of hinting at here, I think, the importance of maybe seeking out some advice, because the target date fund is really meant to be a tool that anyone can just use, sort of do it yourself. It's the easy button. But as soon as you start accumulating a significant amount of assets and you want to be more in control of the mix or the recipe that's going into your portfolio, you could be doing some education, research, figuring out which of the lineup of investment options are worth using and which ones should you steer clear of. Or you can, tap into the knowledge and the expertise of a professional. Your 401k might have an advisor assigned to it that is available to you to get some advice. Maybe that's an option. I tend to say, hey, go with someone who's more independent and who can look at the much bigger picture, asking those other questions that you're referring to, Kevin. Mm-hmm. It's not that dissimilar to when you consider which home improvement projects are you going to do yourself versus hire a professional. If it's like, I'm going to paint the room, or maybe get some new curtains, pretty low stakes decision. You don't have to live with it real long. If you get the paint up on the walls and realize that you hate it, you can paint it again. It's not the end of the world. But as soon as you're like getting new cabinets, moving walls, doing permanent, more, elaborate flooring, that kind of thing, often that's where people say, you know what, I want to work with a professional. I want to have a great designer in place and maybe even more of a craftsman to do the actual work instead of me myself. And so to me, it boils down to, well, how long are you going to live with the consequences of not getting this right? Kevin has said many times, and Mike, you alluded to it, this might be one of the most important financial decisions that you make. Getting the right recipe, the right mix of investments is crucial.
And here's why I would maybe double down on that. This might be, if you're hearing all this and saying, yeah, I actually don't think the target date fund is ideal for my situation, and I don't feel confident picking my own selection or, picking my own mix, it might be time to reach out to a professional and at least get a perspective, an independent perspective, looking at all 6 areas of your financial life to see, well, what is the right mix? But then also what's the right mix in light of this retirement account and the other investments that you already have? That can be another downfall of target date funds is it's not taking into account where you have or how you have your other investments invested, where you're going to begin drawing from in retirement, what dollars will you draw from first, the tax nature of each, whether it's pre-tax, Roth, that sort of thing. And so it might just be time to work with the CFP and get some of those questions answered and certainly get the right mix for your specific situation. So great question, Erica. Hopefully that helps you and those in a similar situation. Next question here comes from Scott, also sent via email through the website. Here's what he said. Hello, I work for a large publicly traded company and have the opportunity to participate in an employee stock purchase plan, ESPP, with offerings every 6 months. So guys, I'm putting you on notice. Let's define how those work. Mm-hmm. Unfortunately, the company stock price has remained flat over the last many years. Does it make sense to still participate in the ESPP to take advantage of the 15% discount? I would sell immediately based upon past experience of holding a stock that really hasn't appreciated, and I realize there are associated tax implications. I'm already fully funding my other accounts like 401k, HSA, Roth IRA. Should I use the ESPP as a short-term investment tool over other options? Thanks for your insight.
That's interesting. So these employee stock purchase plans, these exist at a lot of large publicly traded companies, and it's another form of essentially an employee benefit. It's not that different if you work for a restaurant and they let you eat at a cheaper rate than what the public does.
Or you get one meal free per shift or something like that.
Yeah, something like that. This is just, instead of getting a discount on the services or the product of the company, you are getting a discount on owning a piece of the company. So you get to buy the stock, in this case at a 15% discount. The mechanics of it, I think, kind of matter. And we got some clues from the question here saying that it's every 6 months that you get the opportunity to buy in. So essentially what the employer is doing is withholding money out of a paycheck, stockpiling a bunch of cash, and then at 6-month intervals, whatever the going price of the stock is, they will go buy it on your behalf, but get it at a 15% discount. Now, do you know what the stock price is going to be 6 months from now? No. is today really the ideal time to be buying that stock instead of 6 months from now? I don't know. Sure sounds like this particular company's had a pretty level or steady stock price, which is not what you want when you own a whole bunch of stock. You want to see it climbing. When you're in buying mode, though, I like the idea of buying as many shares as possible in a world-class company at a lowest possible price and then let it appreciate.
Yeah.
But the question it really boils down to, is this a short-term investment tool? That's kind of the essence of how this is being considered for use. I don't personally think of this as a short-term tool. This is a buy a small portion of the company and let it ride for the duration of your career. It's what aligns, when you can own a piece of the company that you work for, you benefit from the good stuff happening within that business.
Yeah, this is a show about financial planning. And I was thinking about this, like, what are the considerations if I'm trying to figure out the ESPP? Well, certainly my present financial position, do I have the money? Does it fit in my budget? If I've got 24% credit cards out there, a 15% discount on the company stock doesn't win. Yeah. So I need to make sure my present financial position is there. Tax planning, do I use it short term and sell it short term and accept more ordinary income or not? Investment planning, diversification. Mm-hmm. How diversified do I want to be? If I'm counting on this company for my income, my benefits, a number of other things, do I want to get even more dependent on this company? And then my retirement plan. Does this fit? Does this help me get to financial independence or whatever you're striving for? Does this take me closer to this? So I personally, I used to get frustrated. I'm like, no, make it simple. Make it make sense and make it simple. And it's just not simple. And if you're willing and able to pull these pieces apart and then reassemble them, it can be pretty spectacular.
Yeah, and that's all helpful perspective because we don't know all of Scott's specific situation, and if you have a similar opportunity available to you, you've got to look at it from a comprehensive financial planning perspective. So we're going to get to the root of that. We've got more coming up here on the Wise Money Show with Korhorn Financial Group. Because,
yep, we're going into the third segment.
We didn't answer the question. I think we're going to disagree. So,
okay, well, hey, do you know, and I don't know if this is bonus content or real content, that a lot of these plans have what's called a look-back period?
What does that mean?
That means, I love that question, because I didn't know this until I started snooping around. It means I buy it at the
lowest price over
the stock price at the start of the offering period or the stock price at the purchase date, the lower of.
Mm-hmm. Yep.
So I could...
And then a discount off of that.
Right. And I could be winning. But I do have to be careful about when I sell it, which is why I want to think about a donor advised one, possibly so.
Which is why, so that's where I want to get to some of that. Because I actually, based on what we know about you, Scott, it's a no-brainer. But we don't know everything. So, all right, here we go. We'll get into that. We'll get into it. I know.
I'm getting ready to throw my cold water on you.
We'll get into that, and then we'll get into the next question as well as third segment. Here we go. If you're looking to build a house, obviously, construction costs are still very high. Mortgage rates are still very high. How do you do it? Where does the down payment come from? And then what's your approach? If you are really wanting to, make progress in your financial life, do you let that high interest mortgage stick around, or do you have an aggressive game plan? We're answering that question from a fan of the show. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show, subscribe to it there and follow us there, and then rate the program there as well. That's helpful feedback for us and helps others that are on their financial journey looking for a comprehensive approach to take their next wise step in their finances, helps them to find us. So thank you very much. Hitting nothing but questions from fans of the show today, and have a doozy here from Scott. And I say a doozy, it's a great one, but we also disagree. And the fangs are coming out. So here's what Scott said, just to recap. He's got the opportunity to to take advantage of an employee stock purchase plan where every 6 months he's buying into his company's stock, but at a discounted rate. He said 15% discount. The stock has not performed well. It's been pretty flat, so he doesn't really love the idea of continuing to do this. But the question is, he's asking, should I still take advantage of this? And by the way, and I think this is critical, he says, I'm already fully funding my 401k, my HSA, my Roth IRA. Should I do this? Okay, guys, feel free to throw your coffee at me. I mean, based on what we know about Scott's profile right there, I think it's a no-brainer. I think you absolutely should continue to take advantage of it. You've got to be mindful of how much of your overall financial life is connected to the health and well-being of the company.
Right.
So and sometimes it's helpful to put up rules or guardrails. I don't want more than 5% of my entire investment portfolio in my company stock. I don't want more than 2%. I don't want more than 10%, whatever it is. And based on you, Scott, what you're saying about the company being, that stock price being relatively flat and not an area that's helped you build wealth, you might have an even lower threshold. I don't want more than 2% of my portfolio. That's where I do like the idea of capturing the discount and then either selling it immediately and just saying, hey, I'm going to pay short-term or, ordinary income tax rates, or waiting the 12 months and just rolling the dice. Well, it might not grow a lot. I might lose a little bit, but capturing the discount, I would. I wouldn't say that that's better than optimizing your tax shelters, but assuming that you're already doing so and you're on track for your other financial goals, I personally, I would do it. I'd take advantage of it. And I would do it from a comprehensive planning perspective, making sure that saying yes to this doesn't mean you're saying no to some other good things or great things, but it just, based on what we know about your situation, I think it's a no-brainer.
Even in a short-term situation, because that's how he framed it, as a short-term investment option. I would be careful also to just make sure that you understand the rules of your...
Right. Is it restricted?
That's right. Sometimes you have to hold the company's stock for a period of time. Might be a year, could be 2 years. I don't know. But I would look into that. You wouldn't want to buy in thinking that this is going to fund, a car purchase in 3 months or 6 months, and you're just trying to take advantage of the discount, and then find out, oh, wait, this money's stuck for some period of time.
Right. You'd want to make sure that you've got, your emergency fund, that Kevin, you're spot on. Like, look through all 6 areas of your financial life. What areas will influence this decision? But if you've got a solid financial foundation, I actually would not worry about this being a short-term investment option. Knowing the risk, it certainly is not risk-free, nowhere near. But if you can buy it at a discount and repurpose the dollars, maybe even to a donor advised fund, Kevin, teeing you up for that.
Yep.
But
Yeah, well, I was thinking, so it sounds like Scott has mastered his cash flow. Some people's cash flow masters them, and some people master their cash flow. So whichever one you are, it's not too late. Take your next wise step in your financial life and get a handle on that. Sounds like Scott has a handle on that. So if all things being equal, the only thing the stock did was stay just static for the whole year. And he bought it. And so in essence, he had a 15% gain. One of the things that he could do, if he really, 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 really wanted to hold the stock, he could take that stock, put it into his donor advised fund, sell it in there. So the donor advised fund isn't going to pay any capital gains or ordinary income on that 15%. The other thing that he could do is, if there was gain in that, say there's a 15% gain in that, the other thing that he could do is gift it to family members who are he wants to give money to. And I'm thinking of children, maybe not even minor children, just adult children who are in the 12% tax bracket. They can sell it immediately and pay no tax.
And zero capital gain, yeah.
And you hit on this. You said if you want to give. And so that's obviously the prerequisite for using a donor advised fund or gifting to family members or whatever. That has to be part of the plan. That's part of the goal that you're trying to achieve. And so don't make this decision outside of the context of your financial plan. That's kind of what it boils down
100%.
to.
Even though, I completely agree. All right, next question here comes from Chris. Also on the website, went to wisemoneyshow.com, filled out a question in the comment section there, came right to us. Hello, I'm 39. My wife is 37. We have no debt outside of the home. Way to go. Way to go. And we've decided to build a new house, which is going to cost approximately $600,000. We've got $180,000 of equity, give or take 5%. And we have $250,000 set aside in a taxable account. And we're wondering how to best handle the down payment with the new house. That's one. And then second, is it better to get this new house paid off as fast as possible since the mortgage interest rate is going to be around 6%? So two-part question. First, Chris, we've all been there. All of us here on the show are older than you and know just how great the sacrifice is and the financial discipline is that's needed to be able to be those ages, no debt other than the house, have that much equity built up, and to be in a financial position where you've got resources available to help with the down payment, be able to. So obviously, you're doing a lot of great things in your finances. Way to go. Keep it up. Down payment. I personally would ask, do you have a home equity line of credit on the existing house? That's not going to get you super, super far, but it could get you 20% if that's what the down payment is needed on the construction loan. I don't know the details of the construction loan, but I would consider, my guess is that the $250,000 in the taxable account is going to have some taxation to it to get your hands on it. Too low of a balance to really get a securities-backed line of credit. So that option, I'm going to say, is probably not there because of the run the stock market's had. That 250 has some gain, likely a decent amount of that short-term gain. Don't really love touching that. And so to me, my first option for down payment is I look at home equity line of credit on your existing home, that equity.
And if you do not have a home equity line in place, it's not necessarily too late to put one in place. You just can't do it when the house is on the market. When you've signaled to the world that this house is going to be sold, no lender is going to come and put a new loan in place on that or offer a new line of credit. But since you're in the construction phase, you've got some time here where you could borrow the down payment, any cash that you have to have. But, usually most construction loans, they are built so that you're not putting too much cash into the deal until there's some sort of an end loan. And at that time, maybe you take the equity out of your house and your former house and get it into the new constructed building here.
Yeah.
Yeah. Go ahead, Josh.
Well, I was just going to say, there was another part of this question, though, and fast forwarding to when now you're living in the house. You've got a beautiful, well-built $600,000 house. Maybe you've got 30% equity in that house coming out of your former one. And the question was, well, do we get aggressive on paying off that mortgage? And that is just such a fundamental financial planning question. And it all boils down to, well, what are your primary goals? And is getting the mortgage paid off early in alignment with you achieving that big goal? I think about retirement, for example. Mm-hmm. At age 39, if let's just pretend that your goal was to be retired at 65, so you've got 26 years, maybe 25 by the time the house is done. Do you put yourself on an accelerated path to have the mortgage wiped out at that time? But in the meantime, by putting extra on the mortgage, you have to ask yourself, well, what could I have done with that extra mortgage payment? Would I have been better off maybe maxing out my retirement plan at work or saving some additional dollars into a Roth IRA, something along those lines? That is what a financial advisor in the context of financial planning is helping you to evaluate. You have options here. If you can afford to pay extra on a mortgage, then you might be able to afford to do something even better. We want to identify what even better could be.
Oh, so much here to hit. So we're going to pick it right back up here coming up on the Wise Money Show with Korhorn Financial Group. Such a great question.
So, okay, but here's the problem. This is the problem with answering questions is they're not complete.
Right.
Because he has $180,000 of equity in his house. Okay? What he didn't tell you is his house is valued at $900,000. So how much of a home equity line could he get? If you can get 80, if they're looking at up to 80% of the equity, he only has 20% down on a $900,000 house. So this is where it's now. If he's got a $200,000 house, he can get most of that out using a home equity line. So this is where it's tricky to do math on the radio.
Right.
And I mean, I have no idea what value this guy has as far as a house and other things, but
Yeah.
I still go back to, well, how much do you really have to put down on the construction loan anyway? But that's the purpose of the construction loan.
I go back to, you better understand the construction loan, because
Yeah.
how many construction loan mishaps have we seen where someone gets to the end, it's all built, and they're saying, hey, give me that 6% interest rate. And they're like, well, actually, it's a 7.5%. And you're like, well,
Yeah, because whatever the prevailing rate is at the time that you finish the project and you roll it into a new loan, that is what you're locking in at, essentially.
Well,
on most.
yes, but I mean, it is possible to structure it
Pre-lock,
that this is my rate, but this is where you really have to know. And most of us are not equipped to ask the right questions, so this is where you want to have your team in place.
Yeah.
All right, let's pick that back up, and then at some point, I'll transition us to the next question. If there's still a decent amount of time, we'll hit Rodney's question. If we're a little light on time, I think Corporal Daniel's question that's been here for so long, Corporal Daniel, if you're listening on YouTube, we'll see where we are at. So, all right, 4-segment land in the plane. Thanks for being here. This is the Wise Money Show with Corhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Corhorn and Josh Gregory. Make sure that you are a subscriber on the Wise Money YouTube channel. Not only is every talk show that you're listening to right now on the Wise Money YouTube channel, but so are Next Wise Step videos that air all throughout the work week, as well as shorts and a lot of other content, different financial series and playlists and so on are all right there. Well over 2,000 videos. So make sure you go to YouTube, search The Wise Money Show, subscribe to it there, turn on notifications so you're made aware every time we drop new content. You can leave comments there. You can leave questions there as well. Engage with us. We appreciate that. We're hitting questions from fans of the show. A great question here from Chris that they are in the process of building a house for $600,000. They've got $180,000 of equity in their existing home and have another $250,000 in a taxable account. How do they approach the down payment? Is first question. How do they tackle the new mortgage once the house is built? Because that mortgage is going to be at 6%, if not higher. Guys, I know in bonus content we were talking a few other issues. What else would you want to make sure are they aware of when it comes to the construction loan? And then we can weigh in on
for
the
sure.
6% mortgage.
I would want to be asking the right questions about the construction loan, because I've seen it where at the beginning when I start taking out the construction loan and we start doing draws, et cetera, at the end, the rate is going to be what it was promised at the beginning. And I've also seen it where at the end they say, well, you thought it was a 6% rate, but it's not that anymore. It's 7.5%. So here you go. And now my budget and cash flow and other things, you have a little kerfluffle here.
Yeah. So I would really understand the details of the construction loan, because it's also very possible you don't need an enormous down payment, that the construction loan can be structured as some sort of a bridge loan and that it can all sort of resolve itself. Work with the right lender. We recommend, I've had this question recently, if I don't have a primary lender that is sort of a partner with me in this, how many do I discuss? We would say work with and talk to at least 3, get good faith estimates, get quotes from each of them, compare them side by side, make sure you're asking the right questions, working with your CFP. And then going to the next question. Then what should your approach be with the new mortgage when it's at a higher interest rate, 6%? You've got to know your present financial position. You've got to know your tax picture. You've got to know your investment and your retirement picture, even your estate plan as well, in order to answer that, wisely. Okay, because based on the fact that you've got $250,000 of resources in a taxable account, makes us presume that you are maximizing and optimizing your tax shelters, but we don't know for sure. I'd want to make sure that you're doing that. That could influence the decision on, do you go gangbusters on attacking that new higher interest mortgage or do something else first? Start with your tax shelter strategy. Start with your goals. Are you on track? And if you've got the right tax shelter, if you are then on track and there's resources still available in your present financial position, I wouldn't mind paying extra onto the mortgage, but it would be after you're on track for those other big goals.
That's right. The other thing we don't know about this story problem here is how is that $250,000 positioned? It's framed as a taxable investment account, but it could be sitting in a money market fund for all we know.
That's true.
There are plenty of people out there who locked in, during the COVID years and the aftermath there at obscenely low mortgage rates. Maybe you're paying 2.5% or 3% on your mortgage, and you've had no incentive to pay extra on that mortgage because it's such a low rate. In fact, you've been piling money up in a bank account potentially earning 4% or even higher at times. And so if this money is not actually invested in long-term assets that are growing and appreciating in value, maybe have some taxable gains embedded there, then if this is money that we might consider lazy assets, they're earning 4%, that's better than what your cost of borrowing is today. But in the new world with a new mortgage, now all of a sudden you're borrowing at 6% and you're depositing money at the bank at 4% or something even less. Now that money is truly costing you by sitting there, and you may be better off. Maybe this was even part of the original strategy. I'm building up additional resources that will eventually go into my next house at some point.
I think a lot of people, the calculus has changed with as interest rates have dropped, as the Fed has lowered interest rates. That means the interest that your savings account is earning or money market's earning is much lower. And a lot of people have gotten frustrated that we haven't seen the same sort of decline in mortgage rates. And so the calculus is changing. Make sure you're making a planning decision, looking at all 6 areas of your financial life. All right, here we go. Next question from Rodney on the YouTube channel. I am a teacher with a pension and Social Security. I retired this year at age 62. I'm not getting Social Security yet, but I'm going to turn it on later this year in the summer. I have about $127,000 left in 2 403B accounts. I'm single, and I've thought about converting it to a Roth, but I'm not sure it would make much of a difference for me. I have CDs well over $175,000 now and savings of another $70,000. Would you suggest taking the 127,000 403Bs and moving it into an IRA or to the Roth? By the way, I live in Florida, so only federal taxes. Oh gosh, I think it's got to start with, and it sounds super geeky, but we share this all the time. You need a multi-year tax projection. You need to build out right now in beginning of 2026. All right, what do you think this tax year is going to look like in 2026? And then what does it look like in 27? What's it look like in 28? And you need to start looking, well, does it make sense to do a Roth conversion of all of these dollars right now? What tax bracket will that push you into? The one thing we know is it's not going to, we don't believe, I don't know when your birthday is, it won't count towards IRMA because you're only 62. In the prior year rule, you should be safe if you want to convert all of it right now. But what tax bracket does that push you into? What other tax consequences does it create versus doing a Roth conversion, spreading this out over 3 years or 5 years or some extended period of time, or just waiting and taking dollars out over time and not shifting it to the Roth? I mean, I think the only way to know that is to build out mock tax returns for this year and the next several. We call that a multi-year tax projection. Guys, you seen it any differently?
No, I mean, one of the things, I love the idea of thinking in a multi-year strategy, because one of the questions is, should I just convert it all, just rip the Band-Aid off, convert it all and be done? And that can be a problem. I mean, if you look and you say, hey, if I convert it all and this year I have a big tax year, but if I'm 62, I'm not concerned about IRMA or anything, so it might make sense to have a big tax year or not. But I've seen that happen where all of the traditional taxable IRA money got converted, and then there was nothing, there was no lever to move when I said, hey, I want more income for this year. You can't get more income on your tax return unless you go to work.
Right.
And so that's where it does make sense, in my humble opinion, to hold back some traditional money that I've never paid taxes on in a reserve so that as I mix my taxable income cocktail, I can get it mixed just right. Because I'm going to have, likely with my pension and Social Security, there's some tax there. And the question is, how do I optimize my tax situation?
Mm-hmm. Boy, I feel like you guys nailed the question at hand, but there may be another question in here that ought to be asked. And it has to do with Social Security. I would ask the question, well, how set in stone is the decision to start Social Security right now at age 62? Because if you haven't already filed and that's just the plan, but you're open to maybe considering some alternatives, you just have an interesting opportunity here because you're so liquid. You have so much cash in the form of CDs and savings and everything. It's possible that maybe your pension and drawing a little bit of those assets down could allow you to postpone Social Security by some period of time. Mm-hmm. Here's what we know. Every year that you wait to draw Social Security, you're essentially getting an 8% pay raise. And I'm confident that your savings and your CDs are not earning 8%. And so if you redeployed that money to live off of and postpone the Social Security, I wonder, how does the math play out in your favor? Does it put you in an even stronger position for your retirement by just simply delaying?
Yeah. I mean, that's the proactive work. We've shared all along that, what's the benefit of your financial planner? What do they bring to you? Is it strategy, and is it investment savviness? Yeah. All those things. But then clarity, confidence, and creativity. And sometimes just taking a beat, pausing, and taking a creative look at what your options are can really go a long way. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Corhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Corhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Corhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.